Something very unusual just happened, and almost nobody noticed. While most people were watching price charts, headlines, and green candles on their screens, a quiet but violent event unfolded behind locked doors. Not on television, not in press releases, inside metal vaults, inside inventory reports, inside numbers that rarely make the news, the kind of numbers that only change when stress enters the system. In a single day, 4.2 million ounces of silver disappeared from the registered system. Not paper silver, not contracts, not promises, physical metal. That number is not a rounding error. It is not routine. It is not seasonal. It is the signature of imbalance. And when an imbalance reaches this size, markets do not correct gently. They shift regimes. This story is not about excitement or fear. It is about mechanics, about structure, about how a modern financial system reacts when physical reality pushes back against paper claims. And to understand why this matters, the first step is to understand what officially happened. The official event, according to public records, was simple. A daily warehouse report was released. These reports are published quietly, without headlines or commentary. They list how much metal entered and left approved vaults. Most days, the numbers are small, tens of thousands of ounces, sometimes a few 100,000. This time, the number was 4.2 million ounces out. More important than the total was where it came from. Large withdrawals were recorded across multiple vault operators, CNT, Asahi, Brinks, and most notably, JP Morgan, where over 1.2 million ounces left in a single reporting period. This was not one buyer. This was not one decision. This was coordinated behavior responding to the same signal. At the same time, the registered silver category collapsed by roughly 1.7 million ounces, pushing total registered inventory down to approximately 114 million ounces. Registered silver is not just storage. It is the metal available for delivery against futures contracts. It is the foundation beneath the paper market. It is the metal that turns a promise into a settlement. When registered inventory shrinks, the leverage of the system increases automatically. The same number of paper claims now rest on fewer physical ounces. At $100 per ounce, the entire registered silver supply is worth roughly $11 billion. In modern financial terms, that is not large. It is smaller than the daily trading volume of many technology stocks. Yet this relatively small pool underpins a global pricing system for silver. That is why this withdrawal matters, because it did not happen in isolation. To understand the pressure behind the vault drain, it is necessary to step back and look at how silver is traded in two very different forms. There is the paper market, where silver exists as contracts, derivatives, and positions. This is where prices are quoted, charts are drawn, and liquidity appears deep. Then there is the physical market, where silver exists as bars, weight, purity, transport, and custody. This market does not care about leverage. It only responds to availability and price. For decades, these two markets moved together closely enough that the difference did not matter. Arbitrage kept them aligned. Trust filled the gap. That alignment is now breaking. In the paper market, silver was trading near $98 to $19 per ounce. In the physical market in Asia, specifically on the Shanghai Futures Exchange, silver was trading around $113 per ounce. That is not a small premium. It is a $14 gap on a roughly $100 asset. In percentage terms, it is massive. Such a gap does not represent inefficiency. It represents tension. In normal conditions, arbitrage closes small price differences. Traders buy in one market and sell in another until prices converge. But when the gap persists and widens, it signals something deeper. It means one market is no longer willing to release supply at the price the other market is offering. Paper markets can quote any price. Physical markets must deliver metal. When the physical market raises its bid to 113, it is stating clearly that silver at $99 is not available in size without consequence. This creates a vacuum. Metal moves toward the higher bid, not theoretically. Logistically, bars are withdrawn from vaults, ownership is transferred, delivery is requested. This is not speculation, it is flow. And that flow showed up in the COMEX vault data. The vault system itself is often misunderstood. COMEX-approved vaults hold silver in two categories, eligible and registered. Eligible silver meets contract specifications but is not committed to delivery. Registered silver is explicitly available to settle futures contracts. Only registered silver can satisfy delivery demands. When registered inventory declines, the system does not fail immediately. It becomes fragile. With approximately 114 million ounces registered and futures open interest representing multiples of that amount, the system relies on most participants choosing cash settlement rather than physical delivery. That assumption works until it doesn't. A withdrawal of 4.2 million ounces in one day represents roughly 3.7% of total registered inventory. That is an enormous daily percentage move. More telling is who withdrew. JP Morgan has long been viewed as the largest and most stable custodian of silver in the Western system. Its vault was considered a buffer, a backstop. When metal leaves that vault in size, it indicates a preference change among holders, a decision to move metal out of the exchange system entirely. This is not emotional behavior, it is calculated. At the same time, withdrawals from other vaults show that this behavior is not isolated. Multiple parties responded to the same incentive. The incentive was the $14 price differential. At that spread, the economics become obvious. Withdrawing metal, transporting it, and selling it into the higher price market becomes profitable even after logistics. This is why paper price suppression, if it exists, becomes self-defeating. The lower the paper price, the stronger the incentive to remove metal. And that is exactly what happened. Institutions do not act without motive. Banks, refiners, custodians, and large holders respond to incentives, risk models, and balance sheet considerations. They do not react emotionally. They reposition. When a persistent global price spread appears, institutions face a choice. They can leave metal in a system where it is priced lower, or they can convert it into liquidity or redeploy it where it is valued higher. The decision to withdraw physical metal does not imply panic. It implies recognition that paper pricing is no longer fully representing physical scarcity, recognition that holding metal inside an exchange carries counterparty and rule change risk, recognition that delivery optionality matters more than yield or convenience. It is important to remain neutral here. There is no need to assign intent beyond rational behavior. Institutions are not villains. They are participants in a system responding to stress. The system itself was designed for abundance and trust. It is now being tested by constraint and divergence. When stress appears, institutions reduce exposure to structures that rely heavily on confidence. That is what the vault data reflects. Retail participants experience this process very differently. For individuals watching the market, price is often the primary signal. A number on a screen, a chart, a candle. What is not visible is the plumbing beneath. When silver approaches $99, it feels like a milestone, a psychological level, a story. But behind that price, something else is happening. Paper liquidity remains deep. Physical liquidity is tightening. Retail buyers often interact with the market through coins, bars, and small quantities. They notice premiums rising, delays increasing, availability fluctuating. This creates confusion. If silver is $99, why is physical harder to find? If inventories are sufficient, why are vault withdrawals accelerating? The answer lies in the separation between paper representation and physical settlement. Retail participants are not causing the vault drain. They are observing its effects. Their experience reflects a system where price discovery is lagging behind physical reality. That disconnect creates psychological tension. Some feel excitement, others feel disbelief, many feel uncertainty. These reactions are normal. Markets undergoing structural change always feel unstable before they reprice. The key point is that retail behavior is not driving the imbalance. It is responding to it. This brings the story to its final phase. When a system shows signs of stress, several paths become possible. In one scenario, prices adjust upward until physical supply returns to the market. Higher prices encourage selling. Balance is restored. In another scenario, rule changes occur. Settlement terms shift. Cash settlement becomes dominant. Physical delivery is discouraged. In a third scenario, parallel pricing systems emerge, where physical markets operate independently of paper benchmarks. Which path unfolds depends on behavior, policy, and time. What is clear is that the 4.2 million ounce withdrawal is not noise. It is data. The collapse in registered inventory is not theoretical, it is measurable. The $14 global price spread is not opinion, it is observable. Together, these signals indicate a system under adjustment, not a crash, not a collapse. A repricing process driven by physical constraint. History shows that when physical markets assert themselves, paper markets eventually follow. The timing is uncertain, the path is uneven, but the direction is determined by flow, not narrative. This moment will likely be studied later as a transition point, a period when the paper representation of silver began to lose its dominance over physical reality. Not because of belief, because of math, because of inventory, because of delivery. And because metal, unlike paper, must exist somewhere. When it starts leaving, the system notices, even if most people do not.